afternoon, everyone. Thanks for tuning in to today's webinar, Winning Charitable Strategies for a Shifting Charitable Landscape. My name is Mike Citrick, Executive Vice President for Advancement here at DuPage Foundation, your local community foundation, and DuPage County's philanthropic leader. For the next hour or so, I'll be your host and moderator as we delve into the world of charitable giving and explore a variety of factors that may affect the current landscape and influence your tax and gift planning strategies for year end and beyond. Joining me this afternoon to share their knowledge and expertise are two industry experts from our partner, the Northern Trust, Katrina Pippist, Director of Plan Giving Services, and Ken Little, Associate Tax Counsel. Welcome, Ken and Katrina. It's a pleasure to have you with us today. Would you each take a moment to tell us a bit about yourself and your areas of practice?
Thank you, Mike. Hi, everyone. I'm Katrina Pippist, and as Mike said, I am the National Director of Plan Giving Services here at Northern Trust in the Foundation and Institutional Advisors practice. I work closely with institutions such as DuPage Foundation in gift administration and investment management for charitable gift annuities and charitable remainder trusts, where the institution actually is acting as the trustee for those trusts. I also serve as board president of a local Montessori school.
Excellent. Ken?
Thanks, Mike. Good afternoon, everyone. I'm Ken Little, Associate Tax Counsel at Northern Trust, where I've been for about 3 years. I primarily work on tax and wealth transfer strategy issues and contribute to the Northern Trust Institute as well as the Tax Policy Research Center. I attended Howard University in Washington, D.C. for undergrad and went to Loyola University Chicago School of Law for law school. Go Ramblers.
Go Ramblers as well. That was my alma mater. Well, let's jump in. There's definitely a lot of factors at play right now that could potentially influence how we all plan and give, from lingering effects of the pandemic and concerns about market stability and inflation to the looming likelihood of tax reform and the possibility of some new legislation that could change the rules for those who give through donor-advised funds and private foundations. So before we get into the weeds, let's take a look at exactly what we'll be covering today. I'm going to share the agenda slide here with you. You all see that? All right. So we're going to talk about 4 main topics today: proposed tax law changes, proposed legislation for donor advised funds and private foundations. We'll also share a bit about savvy year-end giving strategies, and then talk about some effective ways to create a charitable legacy. And for those of you tuned in, we've built in some time to answer your individual questions. So please don't be shy about posting in the chat box. You should be able to find that at the bottom of your screen, and we'll do our best to address them all by the end of the program today. But let's dig in here. Ken, I'd like to start things off with you.
Sure.
There we go. So there's been a lot of talk about tax reform over the course of the year, and legislation has been advanced in Congress containing elements of the Biden administration's Build Back Better plan. Can you share some of the key provisions currently on the table and their potential implications?
Absolutely, Mike. To start, on September 13th, the House Ways and Means Committee introduced the tax elements of the Build Back Better plan. And I don't think I'll be saying that too often. I'll just refer to it as the House bill. But it includes much of what we see here. And as you'll see, the green boxes indicate those proposed tax provisions that were included in the House bill, and the gray boxes indicate those tax provisions and proposals that weren't explicitly included in the House bill, but are currently up for discussion and consideration. To start, the most likely changes that we see relate to increases to the top individual income tax rate of 39.6%, an increase to the capital gains tax rate, which would jump from 20% at current law to 25%, and increases to the corporate tax rate. As far as individual income taxes, this would apply to single individuals who earn more than $400,000 in taxable income, as well as those who are married filing jointly with more than $450,000 in taxable income. The effective date would be for after 12/31 of this year, so to apply in 2022. Now, this change is a little different than the current capital gains tax proposal, as that effective date is currently set at September 13th, 2021. And as mentioned, the rate would jump from current law at 20% to 25% for those same individuals. A single individual with more than $400,000 in taxable income, and those who are married filing jointly with more than $450,000. For the corporate tax rate, we saw this rate decrease significantly under the Tax Cuts and Jobs Act in 2017, from 35% to 21%. And while 21% is where it currently stands, the current House bill proposes to raise that rate to 26.5%. And it would also implement a graduated rate structure on corporations, which phases out for those corporations with more than $10 million. As for those changes that are likely in some form, we have a reduction in the gift and estate tax exemption amount to $5 million, limitations around grantor trusts, and this is new. It's a surcharge on individuals, trusts, and estates. And this new proposed provision would impose a surcharge of 3% on an individual who has a modified adjusted gross income greater than $5 million. Now, this surcharge would also apply to trusts and estates, but it will come in at an income threshold of $100,000. Moreover, there are restrictions around IRAs that are currently proposed, which would change the landscape for things such as the backdoor Roth conversion strategy, which is immensely popular. And in addition, it would there are also changes to increase the carried interest holding period from 3 years to 5 years, which would also be taxed at capital gains rate. So it's important to kind of view that provision in light of the changes to capital gains as well. A big one here that's not explicitly in the House bill is modifications to the state and local tax deduction. That limit is currently $10,000. And while it wasn't explicitly mentioned in the House bill, there was several lawmakers that expressed a desire to include some form or modification around the sought limit in this House bill. As for the unlikely,
go ahead. Sorry.
I'm sorry, Mike. As for the unlikely changes, we heard a lot about the elimination of stepped-up basis at death, reinstating itemized deductions with limitations, in addition to a limitation around 1031 exchanges. And these are not included in the current House bill.
That step up in basis was one I know a lot of people were concerned about, and advisors too, just particularly how to really administer that and try to get everybody's records right. I mean, that's
absolutely. There's a bill that came out earlier this year that Senator Sanders was a sponsor for, and it really put the stepped up basis in sort of the limelight. But I think a lot of people were glad to see that this wasn't exactly included in the current House bill. However, it may still be under consideration, just so everyone can know.
The gift tax exemptions were scheduled to roll back anyway, so this would just really be kind of an acceleration of that. But the grantor trust limitations, that's also a big one too, right?
Absolutely, Mike. This change could impact grantor retained annuity trusts, spousal lifetime access trusts, even intentionally defective grantor trusts. So this is actually a very big change, and one that we are actually monitoring very closely.
So let's kind of keep going here. I know there's a lot of uncertainty right now. What is the likelihood now with these in terms of passing here? I know you want to comment on this slide a little bit.
Absolutely. So, while the political path forward is very uncertain, we know there's no crystal ball, there's no magic 8 ball that can give us the answer on, whether this proposed legislation will make it through. But this is what we do know, Mike. And that fact is that the Senate and House of Representatives are essentially in a political gridlock. Essentially, in the Senate, for this to pass, all Democratic senators would need to hold together for this legislation to go through. And for the House of Representatives, nearly all of the members in the House would have to hold together Democratic members for this legislation to pass as well. And I do want to take a moment to focus on the Senate because this is where we see that most of the hurdles lie. As you can see, we currently have 50 Republican senators and 48 Democratic senators. Now, those two independent senators are Senator Angus King of Maine and Senator Bernie Sanders of Vermont. Now, while those two senators identify as independent, they largely caucus with the Democrats. And in addition, another senator that I'd like to note here is Senator Joe Manchin of West Virginia. Joe Manchin is a conservative-leaning Democrat and has made it clear that he staunchly opposes any bill that includes excessive spending. Now, in that vein, when it comes down to a vote, if the Senate were to end up in a 50-50 split, meaning 50 senators vote in support of the bill and 50 oppose it, that's when Vice President Kamala Harris would step in to deliver that tie-breaking vote.
And the mood with this is that something probably is likely going to happen. There's going to be some negotiations, some back and forth, and maybe that the Biden plan is going to get chopped down a little bit. Any other commentary on that?
Absolutely. I mean, those negotiations are ongoing. It seems like there's going to be some compromise with the plan, and I think the goal is to get something done rather than have anything wait, especially before the end of the year.
That's kind of their window with it being an election year too, right?
Absolutely.
Well, let's keep looking. I know you wanted to talk particularly, in terms of, the thing, and we kind of jumped ahead a little bit, but that in terms of when all of this might get enacted. So we got January 1st here. Some of these others potentially retroactive.
Absolutely. So what we view currently are pretty much 4 potential outcomes on when tax legislation could become effective. The most likely being January 1 in 2022, so next year. Another alternative might be the date of enactment, which would relate back to when the president actually signs the bill into law. Another option may be the date of introduction of the bill to Congress. And a prime example there would be the provision around capital gains, which has an effective date of September 13th, 2021. And that was the date that the bill was introduced to Congress. What we view as least likely in this case is any retroactive changes, even one that could potentially go back to January 1st of 2021. But this is a pretty unpopular outcome and one that we view as the least likely of the 4.
So keeping the focus on charitable giving here, what do you see as some of the implications here with regard to people as they're doing their planning and giving into the year?
Absolutely. And with these proposed tax policy changes, I just want to focus on 3: individual income tax, capital gains tax, and then the gift and estate tax exemption amount. Now we know that there's a proposal to increase the individual income tax rates. So the impact from a charitable giving perspective would be that on one hand, higher taxes leads to less cash on hand to actually donate away to your favorite missions and causes. However, and it becomes a little bit of a balancing act here, because when rates do go up, charitable giving becomes even more attractive because it generally allows donors to reduce the amount of taxes that they do pay. And a caveat there, Mike, is that, while donors give for a variety of reasons, tax savings is typically more of an incentive rather than a motivator for giving. Now, as it relates to capital gains, the option to gift appreciated assets and securities to charity continues. And that will allow for an immediate income tax deduction while avoiding any capital gains. And we could see this increase in popularity for those donors who are actually concerned about a large capital gains bill if this proposal becomes law.
What about the gift and estate tax exemption?
So the gift and estate tax exemption would reduce the exemption amount by almost half. Right now, we're at an exemption amount for an individual that totals about $11.7 million. And the current proposal seeks to reduce that to $5 million, which is indexed to inflation. And that index to inflation amount is estimated to be about $6 million in 2022. So if this were to actually pass and become law, we may very well see a potential uptick in giving for those individuals who want to take advantage of the increased lifetime gift and estate tax exemption amount while it remains in effect.
Kind of a limited window to act on that. So if people are thinking about it, they should probably reach out to their tax attorneys and CPAs and get going. Right?
Absolutely, as soon as possible.
Excellent. Well, I appreciate that, Ken. I'm going to stop sharing my screen here, and we're going to get Katrina back in the game here. Actually, we've one other thing I want to cover and ask you about, and this has shifted a little bit. There was a proposed piece of legislation that we've gotten questions about from many of our donors here and fund holders. This past June, Senators King and Grassley introduced legislation that, if passed, could drastically affect the charitable giving landscape, particularly for those who use donor advised funds and private foundations. What can you tell us about the Accelerating Charitable Efforts Act, or known as the ACE Act?
So the ACE Act, I believe, was introduced early June 9th of this year. Like you mentioned, the two co-sponsors were Senators Grassley and King. It is bipartisan legislation, and it would seek to impact donor advised funds in a pretty significant way. It would essentially create three categories of donor advised funds, which include a qualified donor advised fund, a qualified community foundation donor advised fund, and a non-qualified donor advised fund. So the changes there vary. However, the silver lining there for donor advised funds is any future contributions, it would only affect future contributions, and it would grandfather existing donor advised funds. For the private foundations, it would modify the rules around the payout requirements. And essentially, private foundations have annual payout requirement rules to pay out 5%. And a part of this legislation would disallow, as a part of that annual payout, administrative expenses paid to a disqualified person, someone such as a significant donor or a related party like a family member. And it would even target distributions made to donor advised funds. So just to give everyone and our attendees a pretty high level view of what the proponents of the ACE Act view and what the opponents of it kind of contend is that the proponents argue that the policies in the bill increases the transparency that's needed to build public trust while improving the flow of existing resources to these working charities. Now, on the other side, the opponents of the ACE Act say that these philanthropic resources already flow to working charities at a high rate, and it ultimately may end up adversely impacting the administrative flexibility that's required to invest in these communities thoughtfully.
So we're obviously talking about some pretty sweeping reforms here that could impact donors, private foundation administrators, and sponsors of donor advised funds like community foundations and also the larger commercial houses like Fidelity and Schwab that host them. Given the laundry list of pressing priorities right now in Congress, that's on the table, how likely do you believe that this legislation is going to reemerge? It's not in any of the current proposals, correct?
Correct. It's not in any of the current proposals that are currently on the table. But I will say that this is actually taking a back seat to the Build Back Better Act. I think that's high priority for lawmakers on Capitol Hill, and it will continue to be until something gets done. However, because of the bipartisan support, I would say to keep an eye on the ACE Act in the future, which may come with some additional co-sponsors in the future to help give it some traction. Or maybe not. So we'll have to keep an eye out.
Probably not in an election year next year.
I'd agree with that.
Yeah. All right. Well, Ken, thank you for sharing this. I appreciate that. I'm going to now jump over to Katrina here. If we can get her back on screen. There she is. Thanks. Appreciate you being patient, Katrina. So, having listened to Ken's commentary and given what you know about the shifting landscape and uncertainties discussed, how are you and your colleagues advising folks to plan from a charitable perspective?
Mike, I think it all comes down to planning, but not predicting. So truly plan, don't predict. And first of all, talk to your team of advisors. That includes, your legal or tax counsel, your CPA, your banker, or your wealth manager to review your current tax situation. They are the ones who can model potential outcomes and strategies for you, especially when you review your estate plans, as well as your charitable plans for the remainder of 2021, and also your charitable giving plans for next year. The key is to maintain flexibility because the best strategies are built around truly your long-term goals rather than predictions of potential policy changes. And as Ken mentioned earlier, we have to keep in mind that even if any proposed changes to tax policy become law, their final forms still really remain uncertain.
That's a great point. So, keeping that in mind, are there some, from a charitable perspective, are there some strategies that donors can utilize this year with certainty to help them give efficiently and effectively?
Yes, there are a handful of strategies that can satisfy donors' charitable goals this year that can still provide for a tax-efficient solution. And as illustrated on this slide, there are 4 strategies that I would like to highlight. And the first one is regarding the Consolidated Appropriations Act that brought the COVID-19 and economic relief extended. It actually extended the CARES Act charitable incentives. And taxpayers who do not itemize their deductions on their tax returns can nonetheless claim a $300 above the line deduction for cash contributions to qualified charitable organizations. And it doubles the deduction to $600 for taxpayers who are filing jointly. However, you have to remember that these cash contributions do not qualify for the deduction if it is made to a donor advised fund or a supporting organization. So only to a qualified charitable organization. Now, for taxpayers who itemize, the CARES Act, as you may recall, loosened the limitations on charitable deductions for cash contributions made in 2020, boosting it from a 50% deduction to 100% deduction on your AGI. So the Consolidated Appropriations Act carries that over to 2021. So taxpayers who itemize can deduct up to 100% of their contributions against their AGI for cash donations to a public charity and deduct up to 60% of AGI for cash donations to a supporting organization or a donor advised fund. Now, a charitably...
Go ahead, sorry.
Oh, no. So a charitably inclined individual may want to consider a QCD, and that's also called, the qualified charitable distribution. And some people may also refer to it as the IRA charitable rollover. And that actually satisfies not only their required minimum distribution from their IRA, but also allows the donor to make a non-deductible donation to a charity. Now, you have to remember that the QCD is excluded from a donor's taxable income. Therefore, it also classifies as non-deductible donation. And this strategy is also a useful planning tool for individuals who claim the standard deduction and do not itemize charitable donations. Now, of course, there are requirements. You can give up to $100,000 each from your IRA as a QCD, or $200,000 per couple. It can only be made from an IRA, so therefore employer retirement plans are not eligible. A QCD can only be made to a public charity and not to a private foundation or a donor advised fund. And a QCD has to be payable directly from your IRA to a public charity such as the DuPage Foundation. Now, you must be 70 and a half, at least 70 and a half. And the QCD still applies for individuals between the ages of 70 and a half and 72, even though the required minimum distribution now kicks in at age 72. So that said, with the passage of the Secure Act, IRA account owners must now reduce their intended QCDs by any contribution amounts that they might make to their IRAs after the age of 70 and a half. So instead of committing all these rules to memory, we strongly recommend that you consult with your financial advisor, really to determine the best strategy for you regarding meeting the required minimum distribution, as well as benefiting a charity that is near and dear to your heart.
I think those are really great points that you touched on there, because I know there's a lot of confusion around that with the Secure Act passing and the age now for RMDs to start being at 72. People aren't always aware that 70 and a half, you can still do this. So that's good. And another thing too, with the donor advised fund limitations in that, so we have a lot of donor advised funds here at the Community Foundation. People like to give to those, but we also have several funds where they still can, give from our unrestricted funds, field of interest funds. There's lots of opportunities, and plus, if you've got those charities that are near and dear to your heart, giving directly to those that So, and right. It's nice too with the CARES Act, extensions. A lot of people who aren't 70 and a half now have kind of a similar opportunity to make a tax-free gift like that if they're itemizing.
Right. So
we've got a question on here.
Okay.
Related to that, I think they were asking, what are the chances of the RMD age getting increased in the new legislation here?
Well,
I haven't really seen that come up, but I don't know if maybe have Ken jump in after that in chat, but I don't know that that's on the table right now.
Yeah, Mike, I can chime in on that question after.
Okay, perfect. We'll hold that one. Keep going.
Okay, so the next one that I wanted to talk about, Mike, was giving appreciated assets. And an outright gift of appreciated marketable securities can still avoid capital gains tax to a donor who does not itemize. But if the gift is large enough to allow for a donor to itemize, it really does have a double tax benefit with a charitable deduction also on the current fair market value of that asset. And then we also have to remember that individuals have other types of assets that could potentially be beneficial as a gift. And besides marketable securities, some of your donors may also have appreciated real estate and closely held business interests that can also make for a highly tax efficient charitable gift. The donor may receive a charitable income deduction for the full fair market value of the donated assets and avoid capital gains tax that would have been otherwise incurred if the assets had been sold. Now, we have to remember that the IRS has specific rules, again, regarding appraisal requirements for these assets. So again, as an advice to your donors, be sure to discuss this type of gift, with your team of professional advisors.
And I could answer there too. Just year end, we obviously get a lot of activity. People making gifts of appreciated stock, mutual funds. Those are very common. Stock can be done pretty quickly. Mutual funds take a little bit more lead time, so best to get on those by no later than December 1st to transfer.
Right.
And to your point, if you're doing appraisals or considering a business interest, real estate, those types of things, now is probably the right time because those take lead time. So
yes, I think you made a great point about the mutual funds because they can take up to 15 business days to make it from a brokerage account into the DuPage Foundation's account. So if any of your donors are interested in donating mutual funds, you really truly planning for it now, because there's a lot of paperwork that happens behind the scenes that we don't even realize is going on.
But these types of gifts, these gifts of appreciated assets like that, these are some of the best things to consider really for donor advised funds in that, correct?
Correct. Very much so. And I think a great way to illustrate it is through it's called gift bundling. So even though that the standard deduction has doubled, donors may still be able to itemize contributions by a technique called bundling. And some institutions may also call it bunching. So what happens is this approach involves truly consolidating your charitable contributions into a single tax year that otherwise you would have made over multiple tax years. So in the giving year, based upon the amount, the donor may be able to itemize their deductions. And one way to maximize this technique might be to put their lump sum charitable contribution into a donor advised fund and elect to grant distributions over subsequent years. And in the off years, the donor takes the standard deduction. So in this example, a donor makes a gift of $30,000 to his or her donor advised fund, is able to itemize as a single taxpayer since it exceeds the standard deduction of $12,550 for 2021. And in subsequent years, the donor recommends grants from their donor advised fund and takes the standard deduction instead. So that's a great way to contribute to a donor advised fund and also potentially support not just one charity, but multiple charities by making grants to multiple nonprofit institutions.
We've seen this really grow in popularity since the Tax Cuts and Jobs Act of 2017. A lot of donors are doing that and kind of playing this strategy. So
great.
That's a great share. So for the last section here, I'd like to spend some time discussing effective strategies for folks who may wish to benefit their favorite causes and charities through a gift from their estate. that's a big part of what we do here at the foundation, helping people plan, their legacies. And I know one interesting thing from talking to a lot of our attorney friends, since the start of the pandemic, I know there's been a number of people updating their estate plans that, as they're looking to ensure that their intentions for their loved ones and favorite causes are captured and up to date. It's really skyrocketed. Have you seen that similarly in your practice?
Yes, we have. And actually, when I talk to a lot of the institutions that we work with, we really do focus on this planned legacy part of also capturing some gifts for the future. So let's start perhaps with the simplest ones and move along the spectrum of complexity.
Sure.
So the transfer on death or a TOD account allows the donor to name a nonprofit as a beneficiary without probate. And the most common transfer on death accounts are brokerage accounts, stocks and bonds as defined under the terms of the Uniform Transfer on Death Registration Act. A payable on death account allows the donor to name the nonprofit as a beneficiary without probate in most states using a standard beneficiary designation form. And the most common payable on death accounts are checking accounts, savings accounts, and certificates of deposit. Now, utilizing a TOD or a POD account are simpler than truly creating a will or a trust. And generally, the setup is accomplished by completing the appropriate beneficiary form at the bank or the brokerage house. Now, it is important to understand that these accounts do supersede a will or trust, and these accounts may also be subject to claims by creditors and can have an adverse effect on one's overall estate plan. So careful coordination with your financial and legal advisors is necessary. Now, utilizing beneficiary designations in tax-deferred retirement accounts such as IRAs and 401ks are another great strategy for tax-efficient choices for gifting upon death. And these are perfect plan gifts for donors with a keen appreciation of tax-efficient planning, but a hesitancy to give assets away during lifetime. Again, they are simple to execute with signing a beneficiary designation form, and the funds left to a nonprofit are not subject to income taxes. Now, another advantage is that you can split the designation between your charitable beneficiaries, your family members, or your significant others. But however, funds left, as you all know, to human beneficiaries are subject to income taxes. Also, for our younger donors who have started their professional careers and have deferred retirement accounts, it's a great opportunity to show your commitment today to a nonprofit that is near and dear to your heart. So next up is designating a nonprofit, such as the DuPage Foundation, as the beneficiary of your life insurance policy. Now, if the policy is paid up and no further premiums are required, you as a donor, you can already make the nonprofit the owner and beneficiary of that policy. If the policy is not yet fully paid up, as a donor, you can continue to make the annual premium payments, name the nonprofit as a beneficiary, and perhaps be able to claim a tax deduction for each premium payment, because you would make the premium payment would go to the foundation or the charity, and they would then in turn be the ones who would make the payment. Now, if your mortgage is paid off and your children have been have gone through college, perhaps the current beneficiary of your life insurance policy may not need those funds. So a donor can consider adding a nonprofit as another beneficiary to that life insurance policy. So definitely, I think that the bequest is the cornerstone for a charitable legacy, because it truly can represent a substantial gift from a donor who might otherwise not wish to part with their current assets, yet make a major gift that otherwise might not be possible. In the follow-up materials that will be distributed after the webinar, The DuPage Foundation has provided sample beneficiary language, and the suggested language can be a specific dollar amount, marketable securities, or property bequeathed to a charity. Now, alternatively, a bequest may also be a percentage of a donor's estate to benefit a nonprofit. And also, it can be a conditional bequest, such as a bequest to a charity only if a spouse precedes the donor or is restricted in nature, directing that the bequest is used for a specific purpose. Now, the great thing about a bequest is that it preserves current assets for the donor's use and potentially reduces or eliminates federal estate taxes. Now, the DuPage Foundation prides itself in delivering a full range of different fund options for your bequest. So there's the creation of your own named fund or an unrestricted bequest to the DuPage Forever Fund, a bequest to a field of interest that is specific to a particular area of interest, such as education, animal welfare, or mental health, or perhaps an agency endowment fund or the operating endowment fund is of importance to you. So please contact Mike to discuss how the bequest is to be designated or unrestricted. As we move along the spectrum of ways to give, I just want to briefly touch upon gift annuities and trusts. Now, a gift annuity is a contractual agreement between one or two donors and a nonprofit. The donor transfers assets as a gift to the nonprofit, and in return, the nonprofit is obligated to pay a fixed annuity to one or two annuitants for the lifetime of the annuitants. A charitable lead trust makes a regular income tax deductible gift to a nonprofit, such as the DuPage Foundation, as the income beneficiary for a period of years for the charitable purposes that you specify. When the trust terminates, the remaining principal and any accumulated appreciation are returned to you, the donor, or to your loved ones. And a charitable lead trust often has significant tax savings. And the last one I want to touch upon is a charitable remainder trust. And that's an irrevocable trust that generates a potential income stream for the donor or other beneficiaries, with the remainder going to one or more nonprofits. So if you are interested in creating a trust, it is necessary to engage legal counsel and appoint a trustee for that trust. And again, for additional information on establishing a gift annuity or a charitable remainder trust with the DuPage Foundation, please contact Mike.
Appreciate the plug, Katrina. I think a good point to highlight there are similarities between the charitable gift annuity and the charitable remainder trust. Charitable gift annuities can generally be written directly by the not-for-profit. There's not usually a setup cost involved apart from making the gift, whereas a charitable remainder trust will be much more substantial. I can speak a little bit from our standpoint here, but what do you is there a threshold you generally see in your practice between people doing charitable gift annuities versus charitable remainder trusts?
I think it really comes down to the individual and how much money they are willing to, make the gift. Typically, gift annuities, we see the American Council on Gift Annuities, their recommendation is the minimum is $10,000. So we do see a lot of gift annuities that are $10,000, $25,000, $50,000, and even some that are $100,000. When it gets into trust, because as you said, there's a cost associated with even setting up a trust agreement. Typically, those we see where anywhere from $250,000 to $500,000, and a lot more are seen at the $1 million mark and above.
Great points. Well, I really appreciate that. I know we wanted to leave some time for questions here. So at this time, I know we have a couple in the queue. If we could get Ken back on camera, we can address some of these, and I invite our audience members to jump in with some others that they have. First one I wanted to go back to was there was a question from, what are the chances that the RMD age will get increased? What are your thoughts about that, Ken?
So great question. I believe this question is in regards to proposed legislation on Capitol Hill related to retirement. The bill is called the Securing a Strong Retirement Act, and it's unofficially known as Secure Act 2.0. And for that reason, this proposed legislation seeks to raise the age for taking RMDs from 72 to 75. So while it's still proposed, it's still a potential. And as mentioned before, the high priority is the Build Back Better Act right now. So this proposed legislation, Secure 2.0, is very important, and a lot of lawmakers are behind it. It's bipartisan. We'll just have to wait and see if it actually does become law.
And on the back burner, similar to the ACE Act at this point, right? Just not in the mix of current consideration.
Absolutely.
Excellent. We have, I think, another question here. Just get my chat back. Is there a concern that the stock market will see an impact if unrealized gains are triggered before January 1st, 2022, if capital gains tax increases happens?
I mean, it's difficult to say because we really don't know what will happen. Naturally, the stock market does respond to changes that occur when laws are passed and enacted. So we could see some action, but it's really difficult to say on what exactly may or may not happen.
Any other questions from folks tuned in? I want to make sure we get to all of them. I think we've been pretty comprehensive here. I'm going to stop my screen share. Well, if there is nothing else, I want to, as we conclude, just thank our panelists, Katrina and Ken, for sharing their time and expertise with us today. This was great information and extremely helpful to our constituents as they plan for year end and beyond. I want to also thank all of you who tuned in for the webinar. We're delighted to have you with us and hope you found the program of value. We're hoping to be back in person for these types of events before too long. We miss seeing you all face to face. But again, if you have any additional questions, please feel free to reach out to me, to our panelists, and any of our colleagues here at DuPage Foundation. We'll put our contact info here up on the screen briefly. We're here to help you, and we'll be honored to work with you and your advisors to ensure that you accomplish all of your year-end goals efficiently and effectively. We're going to be sending a copy of today's slides out with some additional detail about the foundation. And along with a copy of today's webinar recording, which we'll also post on our YouTube channel. You can find us on the web at dupagefoundation.org, and be sure to follow us on LinkedIn and Twitter. And we'll also have a brief survey that we invite you to complete to share feedback to help us plan future programs. So thanks again, everyone.